You sell a product for $100. It costs you $70 to make. Is your profit 30% or 43%? This mistake shows up in business plans every day, and it's costing businesses thousands. Stick around to get it right. Hi, I'm Randy, your guide to mastering business numbers. Welcome to this series on profit and pricing essentials. Today we're demystifying gross profit, gross margin, and markup, and showing you how to use them to price smarter and boost your profits. No accounting degree needed, just practical insights from my 20 plus years as CFO and controller. So let's dive in. Definitions and why they matter. Let's break down gross profit, gross margin, and markup with simple definitions and real-world uses. I'll show a quick example for each, and on the screen, hopefully it becomes crystal clear. Gross profit is simply sales minus cost of goods sold. It's a dollar amount. The cash left after covering direct costs like materials and labor. And why this matters? This is the money you use to pay operating expenses, taxes, and hopefully keep some profit. For example, let's assume you have sales of $500,000, cost of goods sold for $300,000, which makes your gross profit $200,000. It's as simple as it gets. Now, gross margin percent is gross profit divided by sales, and it's shown as a percentage. And why it matters? It's perfect for comparing profitability across different products or over time, no matter what the price. For example, product A sells for $100, costs $70, gross profit's $30, the gross margin is 30%. Product B sells for $150, cost of $85, gross profit $65, and the gross margin 43%. You can use these gross margins to compare how product A is compared to product B. In this example, product B has higher gross margin. One might conclude that this is a better product for the company. But obviously, we don't really have enough information to make that decision here. But this is a start. In this example, we're looking at the performance of a single product in year 1, 2, and 3. In year 1, the price was $100 with a cost of $70, gross margin 30%. Year 2, the cost increased to $74 and the price increased to $104. The gross margin 29%. The pricing did not increase at the same rate as the cost, and therefore the gross margin dropped. In year 3, the cost increased to $77 and increased the price to $114. The resulting gross margin is now 32%. So in year 3, we start to make up for some lost profitability. The markup percent is the gross profit divided by the cost of goods sold, shown as a percentage. And why it matters? It's used to set prices by adding a percentage over your costs, which is common in retail, manufacturing, construction. For example, you buy an item for $50 and you add a 40% markup. To get the selling price, you first take the cost and multiply it by the desired markup. So in this case, you get $20. Now add the $20 to the cost, and that's the price. Now let's tie it together with one product. The sales price is $100, costs $70, gross profit $30. Gross margin percent is 30%, and the markup 42.9%. Mixing these up can tank your pricing strategy or leave money on the table. Need to switch from markup to margin? Here's how. Start with the markup rate, then divide by 1 plus the markup percent. Example, 50% is the markup, divide by 1.5 and you get 33% margin. You just switch the other way, start with the margin rate, take that number divided by 1 minus the margin percent. So if you start with a gross margin of 33 1/3%, you divide that by 1 minus 33 1/3, and this gets you to 50%. Keep in mind, some POS systems mislabel these. If your profits seem off, double check what your system is actually calculating. Confusing margin and markup can crush your business. Undercharge, target a 30% margin, but apply a 30% markup. Your real margin is only 23%. And on the overpriced side, you want a 40% markup and you enter a 40% margin. You're actually marking it up 67%, which could scare off your customers. I worked with a retail shop that thought they had a 35% margin. Their spreadsheet was actually calculating markup, giving them a 26% margin. That mix-up cost them thousands and lost profit every quarter. Money they could have used for growth. So don't let this happen to you. Product-based businesses often aim for 30% or more on gross margin. Service firms often shoot for 60% or higher due to the lower cost structures. But the best approach, focus on beating your own numbers from the last quarter. Industry averages can mislead if your costs are unique. Want to improve your numbers? Try these. Cut your direct costs. Negotiate with suppliers or reduce waste. Raise prices with value. Add a feature that customers love. Bundle smart. Pair high margin items with popular products. Track shrinkage. Lost or damaged inventory kills your profits. Pick one to test this week and watch your margins grow. Take a product you sell. Mentally note its sell price and cost. Calculate its gross margin and markup. Were you surprised by the gap? Quick question. A 50% markup equals what margin? Type either 30%, 33, or 40% below in the comments. I'll pin the right answer shortly. Well, that's it for gross profit, margin, and markup. Use these to price smarter and keep more profit. Next up, episode 5, finding your break-even point and margin of safety. Subscribe, hit the bell, and check the playlist below to stay on top of your numbers. Drop your quiz answer in the comments below, and let's keep the conversation going. Well, until next time, have a great day.